All right, let's talk about a tool that's part crystal ball, part blueprint for a business. We're diving into financial modeling, which is really just the art and science of using numbers to get a glimpse into a company's future.
Think about it. How much are we going to sell next year? Is this new company a smart investment? Should we actually launch this product? Business is just full of these huge, high-stakes questions. And the thing is, the future is always a little murky, right? Just relying on a gut feeling? Well, that can be a recipe for disaster. So how do people make these massive decisions with any kind of confidence?
Well, they build a blueprint. You would never, ever build a skyscraper without a detailed plan. It's the exact same idea in business. That plan, that blueprint, is a financial model. It's the essential first step you take before you build anything valuable. Whether that's a new strategy, or figuring out what a company's worth, or mapping out a 5-year plan.
So what is financial modeling really? If we get technical for a second, it's the process of building a summary of a company's finances, all in numbers, usually inside a spreadsheet. And the whole point of this thing is to forecast how the company might perform in the future so you can make smarter, better informed decisions today. But here's a much simpler way to think about it, and I absolutely love this analogy. A financial model is basically a custom-built calculator, but instead of just doing simple math, this calculator actually simulates how money flows through a real, live company. It's built on what happened in the past and on your best guesses about the future. So, this powerful blueprint, what's it actually for? I mean, why do companies pour so much time and energy into building these complex calculators? Well, it turns out they're used for pretty much everything that matters in business strategy. The uses are just all over the map. You can use a model for your annual budget. You can use it for valuation to figure out what a company is truly worth. It's crucial for testing big strategic ideas, like, should we launch this new product line? Investors depend on them to make smart choices, and companies need them to convince people to give them capital. They are absolutely critical to almost every major financial decision a business makes. Okay, so if we're going to build this blueprint, what are the materials? What are the core ingredients that have to go into a financial model to make it reliable? Well, it all has to start with a solid foundation. And that foundation is always historical data. You simply can't predict where a business is going if you have no clue where it's been. This means digging into past sales trends, looking at what costs have been, and understanding the company's cash history. The past really does provide the context for the future. Next up, we have to build the engine of the model. This is where the magic of forecasting really happens. And this engine is built out of assumptions. These are your educated guesses about the future that drive the entire forecast. Things like, what do we think our sales growth is going to be? Or what tax rate should we plan for? These variables are what make the model run. Now, this is the heart of the model, the 3 core financial statements. What's so cool is that each one answers a totally different but totally vital question. The income statement tells you, hey, is this business actually profitable? The balance sheet answers, okay, but what's our net worth right now? And the cash flow statement asks maybe the most important question of all. Do we have enough actual cash in the bank to keep the lights on? Okay, this is where financial models get really, really cool. They don't just give you one single prediction. They let you predict different possible futures. It's kind of like stress testing your architect's blueprint against a hurricane to see if the building will actually hold up. And you do this through what's called what-if analysis. On one side, you've got sensitivity analysis. That's where you just tweak one single variable, like what if our sales growth is 2% lower, to see how much it affects the bottom line. But then you have scenario analysis. That's where you change a whole bunch of variables all at once to paint a picture of a full-blown future scenario, like a massive economic boom or, a nasty recession. And this is what you get as a result. Instead of just one number, you get a whole range of potential outcomes. This chart shows you the profit you might see in a worst case, a base case, and a best case world. This is so powerful because it takes these abstract risks and makes them feel real, something you can actually plan for. It gets you ready for the good, the bad, and the ugly. But look, to make sure your blueprint is a reliable guide to the future and not just a piece of fantasy, there are a few fundamental rules that every master builder, every good analyst follows. Let's run through them. First, and this is the big one, your model is only as good as your assumptions. It's the classic garbage in, garbage out. Second, you have to be obsessive about checking for errors. One tiny mistake can throw the whole thing off. Third, always ground your forecasts in reality by using historical data as your launchpad. And finally, Keep it clean and organized. A messy model is a useless model, period. So when you boil it all down, what's the big takeaway? A financial model is so much more than a spreadsheet. It's a strategic machine. It takes the big, scary, unknown future and transforms all that uncertainty into a clear, strategic plan you can actually act on. So we'll end on this thought. We've said over and over that a model's real power comes from its assumptions. So here's a question for you. If you had to make one bet, one single core assumption about the future of business or the economy, what would it be?